Net interest expense fell by 36% last year. So this is where you get into something that's really heretical, which is that I could make an argument that interest rate cuts are actually going to be the restrictive policy move from here. So what's going to happen is that cash, if you have your cash balances that are now yielding, let's 5.25%, 5.5%, if the Fed cuts interest rates, you'll see the income on your cash fall. However, you're still going to have to refinance your debt at higher levels at the longer end or in the medium term maturities. And so you're actually likely going to see that net interest expense, which had fallen 36% last year, turn the corner and start to see that second derivative turn.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. After a blowout Q1, stocks swooned in April, raising concerns that the bull rally had ended. Nope. The bulls returned in May, and as of this recording, the S&P, the Dow, and the NASDAQ are all trading at all-time highs. Wall Street's confident, the financial media is downright gleeful, and the market momentum has a lot of tailwinds behind it right now. But there are headwinds too. Which will win out as we head closer to the uncertainty of the November elections? For perspective, we're fortunate today to talk with Cameron Dawson, Chief Investment Officer at NewEdge Wealth. Cameron, thanks so much for joining us today.
Thank you for having me.
Hey, it's such a pleasure, Cameron. I really appreciate you fighting to get your way to this interview. I know that you had a lot of other conflicts and things in your way. You're a real trooper for doing this. I very much appreciate it. Lots of things to get through. I've taken some questions from your recent work here. Very excited to kind of dig into these headwinds and tailwinds. Very quickly, just for folks watching, I want to make a quick plea. You'll see at the counter below that we're only about 10,000 subscribers away from hitting 100,000 subscribers on YouTube. There's probably at least 30,000, 40,000 people that are watching this video. So if you can, just take a quick second and hit that red subscribe button below, as well as that little bell icon right next to it. Hit the like button too while you're down there. But if you can help us hit that 100,000 milestone before the summer arrives, that would be fantastic. All right, Cameron, look, lots to get through. If we can, let's kick things off with a general question I like to start these interviews with. What's your current assessment of the global economy and financial markets?
I think we have a starting point of appreciating just how much liquidity continues to slosh around this economy and this market, which is one that we have seen it be incredibly abundant, despite the fact that we've had a Fed raising interest rates up to well above 5%, the talk of the Fed wanting to have policy be restrictive. And yet we're sitting at a point where financial conditions using measures like the Bloomberg Financial Conditions Index are sitting at levels that we haven't seen since the peak of markets in 2021, when if you were to contrast that to today, it's wildly different. Back in 21, money supply was growing in the double digits. You had trillions of dollars being added to the Fed's balance sheet. You had interest rates at 0%, real interest rates. So real interest rates adjusted for inflation were negative, deeply negative at 1.5%. When you put all that together, it is absolutely incredible that this equity market is able to trade at or near valuations back to where you were back in 2021. And that leads you to kind of look in the mirror and ask the question, how can the market, how can the economy be able to do that despite all of this, in quote, work or pain that the Fed had promised us? We think the key reason, and there's such a stark chart to show, which is the forecast for 2023 and 2024 GDP estimates. And what you can see in that chart is that they were revised sharply lower through the course of 2022. So the big bear market in 22 was, yes, it was about the Fed, but it was more about fears of what the Fed would do to the economy. And so what you saw in 22 is every economist said they're going to ruin the cycle. 23 growth is going to be terrible. And so they adjusted forecasts down. So we started the year in 23 with GDP forecasts of about 0.5% for 23 and 24. Over the last 18 months, this forecast for GDP has been revised up significantly. We've added nearly 200 basis points to GDP forecasts over the last year alone for 2024. This is what's underlying strong equity markets. This is what's allowing credit spreads to be at tights that we haven't seen since 21. This is what's allowing this bid for overall risk assets to be very strong, because you're continuously raising forecasts. And you have this benefit from liquidity, overall liquidity still being rather supportive for the market. So that's why the market's been able to shake off a tighter Fed, for example. We've gone from 6.5 cuts to 2-ish cuts today. Why the Fed or the market has been able to shake off higher interest rates, going from a 10-year that was much lower to start the year than it's sitting at today. And so that's why, as we look forward, we think the most important thing to watch is GDP growth forecasts, because that will tell you the risk mood, the risk appetite, the whole regime of risk for this market. As long as they keep rising and you're raising those forecasts, then the risk on move can continue. And you watch things, as you mentioned, things like momentum, technicals, which still remain strong, and without a reason to reverse in the other direction, they kind of keep barreling on.
Okay, great points. Okay, so let's just grab this head on. So I've asked this question a couple of times over the past quarters, but Cameron, is it just all about liquidity? Like, does anything else matter here, or is it just a rising tide rises all boats and an ebbing tide, creates a lot of collateral damage?
The weird thing about liquidity is that it is a self-reinforcing dynamic, and meaning that it's also a self-fulfilling prophecy. So people being afraid of the potential for liquidity to tighten causes them to pull money out of risk assets, to pull money out of investments, put it into safety assets, put it into cash, keep it away from markets, drawing liquidity out of the system in certain ways. And that can create this self-fulfilling prophecy, like in 2022, where liquidity contracted and all the different measures that we can look at it, bank reserves, plus some Fed balance sheet, treasury liquidity. And so that led to big multiple compression for the market. And so we've often said, get the growth cycle right to get the earnings right, get the liquidity cycle right to get the valuations right. And I think if I look back over the last 18 months, the thing that has been the most surprising is the ability for liquidity to remain abundant, even though the Fed was raising rates, which allowed for the ability for S&P 500 multiples to continue to expand, despite the fact that the Fed was raising rates. When you then think of what could drive it in the other direction, it's a great question. I think the reason why liquidity remains so abundant is just because there's still such a big overhang from the pandemic and all the money that was thrown at the system. You still have an incredible amount of fiscal spend that is feeding into this. And so it seems like, without a good reason, it keeps building on itself.
So let me ask this. And first off, like, I feel like the Wall Street Journal, the business section of the New York Times, like, they should just start on page 1 with some measure of liquidity, because it seems so important to everything. But different people measure it differently. It's a little squishy for the average person to kind of get a sense of exactly where we are on the liquidity flows. Let me ask you this. So, I was going to ask earlier, is it that we just shoved so much money into the system because of COVID? And the answer, to a certain extent, I think obviously yes. And with the direct money to households and companies, it really got into the economy in a way that monetary stimulus doesn't really. Monetary stimulus is more indirect. But as you mentioned, we had 2022. Right. So even though we shoved all this stuff into the markets in the end of 2020, 2021, the markets, into the economy, the markets, had a pretty bad year in 2022. So is what's driving liquidity now, is it what we did during the pandemic stimulus, or is it more driven by current flows, like the crazy deficit spending that we're doing, the draining of the reverse repo program that's been going on, the BTFP that was passed last year? What really, to your best estimate, is driving today's liquidity?
It's such a good question because it gets to that fundamental squishy nature of what liquidity is. And I think at the end of the day, liquidity is both a chicken and an egg, to get back to that idea that it's self-reinforcing or self-enforcing or self-creating.
Mhm.
What I mean by that is I question if 2022, the tightening of liquidity that we had was because of an anticipation of tightening liquidity, and the fact that markets were falling, not necessarily because the liquidity was receding to begin with, but because growth estimates were falling. And there was an expectation that you were going to have a recession. You were starting to price that in, which then caused liquidity to recede as people pulled money out of the system, anticipating weaker scenarios. Now, we
Mhm.
do know we had things like M2 money supply growth slowing substantially. It peaked in late 2020, I think, and fell and actually decelerated in 21, started to near towards negative in 2022. But if you had followed that kind of broadest measure of liquidity with M2, you would have been very short this market for the last 18 months and
Mhm.
missed the other parts of liquidity, which include those broader measures like Fed balance sheet, like Treasury general account, like the BTFP, for example, that was done in the aftermath of the SVB. So I think today, as we think about liquidity, is that it ends up being as much of a stock versus a flow kind of question, because it's
Mhm.
also good to remember cash that's sitting around today is earning such a high yield that it then is allowing for greater reinvestment, greater spending, and adds to liquidity in a way that we haven't seen cash add to liquidity in the past. So I feel like I'm, kind of having a 10 hat moment in talking in circles, which is kind of the point, which is that it is a chicken and it's an egg. It's the result and it's the cause at the same time, and it creates this circular kind of creation.
Okay, so I'm going to get to one of my favorite questions here in just a second, but before I ask it, let me ask another one, which is, all right, Cameron, if I had gone back in time with you to the beginning of 2022, and I said, Cameron, look, the Fed is going to take interest rates from practically near zero, and it's going to jam them up above 5%, at the fastest pace it's ever hiked interest rates in history. And then it's going to hold them there for, an undetermined period of time. We don't know how long it's going to be. It's been a while. It's going to be longer. Could you have imagined that? I mean, I would have said, oh, geez, all right, well, the equity markets are clearly going to puke and roll over. The housing market's going to crack. We're probably going to have a pretty bad recession. I mean, just everything you would have expected from that did not happen. And at the same time, financial conditions are looser than they were before the Fed started tightening, right? I mean, it's kind of this crazy, you know, cats and dogs living together, that line from Ghostbusters kind of world. And it is what it is. So, we can't deny what is happening in front of us. But I guess I'd love any reaction to that. Like, were you as taken by surprise, or your peers on the street, were they taken by surprise in the sort of same way that it just seems to have had the exact opposite outcome we would have thought? Let me ask
Yeah.
that question. I'll take a beat and then I'll get to my big one.
Yeah, 2022, played out, I think, as most people expected, for the beginning of a tightening cycle that was expected to hit growth, meaning that we saw the traditional things slow down. Your highest beta parts of the market slowed significantly. Think speculative tech, IPOs. You saw venture really slow down, and those are liquidity
Right.
sensitive parts of the
Right.
market. They respond
And
when.
just true that they had been red hot coming into 2021 too, right? Yeah.
Exactly. So if you're looking for evidence that liquidity was a factor, there's your evidence, because
Yeah.
they tend to be in crypto in the same way, tends to be a liquidity sensitive asset, and it responded. But the difference is that, and I think this is where we get into back to that chart about GDP forecasts, where 22 was so much about the expectation that these rate hikes were going to hurt growth. But then what happened is they didn't hurt growth. And at the beginning of 23, we wrote a piece called "No Land Before Time," in ode to the wonderful dinosaur children's movie, which was effectively saying balance sheets are different this time around. Balance sheets have been termed out. 2/3 of the high yield index issuance in 2020 and 2021 was for refinancing. The 10-year hit 0.5% in the summer of 2020. It started to rise after that, but still historically incredibly low interest rates. Spreads in 2021 hit near all-time tight levels for investment grade and corporates. The end result is that you saw a massive flood of refinancing, of issuance of debt that allowed companies to effectively immunize their balance sheets against short-term interest rates. We can measure this by looking at the average duration or average maturity of the debt that spiked up during 20 and 21 because there was this extension of duration. You can also measure it by looking at things like corporate commercial paper balances, which prior to the recessions in 2007 and 2000, what you saw is that they tended to spike because companies started to rely on more short-term financing. Fed raises rates, and all of a sudden everybody gets caught flat-footed because they have borrowed short-term money to fund long-term liabilities, and that's a big problem. So what we saw this time around, though, is that companies were able to utilize the incredible, unprecedented amount of liquidity and access to capital markets in 2020 and 21, immunize their balance sheets. And this led to the most incredible thing that happened over the last year, which is that net interest expense fell. It's the first time it's fallen in during a rate hike cycle since the 1990s. All this means is that the cash that companies were earning on their interest on their interest, the interest income that they're earning on their cash was much greater in its increase than the cost of their interest expense. So net interest expense fell by 36% last year. So this is where you get into something that's really heretical, which is that I could make an argument that interest rate cuts are actually going to be the restrictive policy move from here. And what I mean by that is that what you have is a dynamic where that debt that was refinanced in 20 and 21, a lot of it being high yield debt that we're talking about right now, has an average maturity of about 5 years. That's the average maturity, 5 to 7 years for high yield debt. It starts to be refinanced in 2024, late 24 and into 2025. What's interesting about that is that right now, and we'll talk about investment grade for a second, the entirety of the yield curve right now, of the treasury yield curve, is above the average coupon for the investment grade index, which means that no matter what, you're refinancing at higher rates. So what's going to happen is that cash, if you have your cash balances that are now yielding, let's 5.25%, 5.5%, if the Fed cuts interest rates, you'll see the income on your cash fall. However, you're still going to have to refinance your debt at higher levels at the longer end or in the medium term maturities. And so you're actually likely going to see that net interest expense, which had fallen 36% last year, turn the corner and start to see that second derivative turn. I think that's why things have played out so differently this year, is because of balance sheets. And it's something that it's one of the reasons why we didn't think we'd have a recession last year, why we don't think we'll have a recession this year, why a recession in 25 is possible, but not in at least the first half in our base case yet. But it starts to pinch more because you actually feel the impact of higher rates once you get into this refi cycle.
All right, super valuable point you're elucidating here, which is that, yeah, because companies were able to lock in historically, generationally, all time in history, low cost of debt. Not only did they immunize their balance sheets, like you said, but because their cash balances were earning more, they're actually net in a much better position, or have been for the past couple of years. Again, I probably didn't see that one coming. But fascinating to your point that we may see as the Fed begins to embark on rate cuts, if Jerome Powell is able to proceed on the trajectory that he says he wants to go on, that could actually be the restrictive thing.
Yeah, do you remember that article from, it was an open letter to, that bankers wrote to the Fed back in, I think, 2011, something like that, where they said, QE is going to be inflationary. what are you doing? This is going to be terrible. You're going to create this awful outcome. And then we looked around, we're like, QE is not that inflationary, but what's the problem? And nobody could really tell what the long tail of QE was. This is it. The long tail of QE is that the Fed has effectively reduced their ability to control the business cycles through the short end of the yield curve. Who would have thought?
Interesting. Super fascinating. Okay, so then that gets to the question I was building up to, and maybe you've given already a little glimpse of your answer to it, but so something that I talk about all the time on this channel, and this time will be no different, is the lag effect. A lot of people have said, yeah, it's different this time. Doesn't matter, it hasn't arrived. I think you've given really two important reasons why it hasn't. One, there's so much liquidity out there just driving growth and supporting asset prices and stuff like that. But then there's been this favorable condition in the balance sheet, and you use the word immunized, which I think is a good analogy, because if you get a vaccine, you'll oftentimes get immunity to whatever the disease is, but it wears off after a period of time. So I think you even mentioned a lot of that debt that was taken out, begins to come up for maturity around the end of this year, beginning of next year. We've heard the alarm bells for a while now about the whole corporate debt maturity wall, and look, you gave a good reason why lower rate cuts could be restrictive, right? Because it reduces the interest income they're getting on their cash. But let's say Powell's right? Let's say he does 2 or 3 rate cuts over the next 12 months or whatever. We're still hanging out in the high 4s at that point in time, right? I mean, that debt increase that these businesses are going to take on is going to be very material. In certain cases, maybe more than double than what they currently have on the books, right? So is there a way to avoid the lag effect here, or do you expect the lag effect to begin to arrive here? It's just been buffered by the trillions in stimulus and the years that these corporations bought themselves in the balance sheet.
I think that it eventually arrives, but we have to appreciate that we did have the cycle from the expectation side of things in 2022. And I think there's some people who talk about saying, well, we effectively had the recession of the cycle in 22 and 23 and early 23, and then we moved on from it. So there's no down cycle to be had. So the counter argument to the idea that you're going to get a lag is to say, we've already felt the impact. I don't think that that's the case, meaning that I still think you're going to get the lag in the impact of higher rates. It's just longer and laggier this time because of the nature of the balance sheets. And so, yes, we had 22, which shook out the expectations part of the channel. So you saw housing activity slow materially, even though rates weren't that high. Housing activity is higher today than it was in 2022, not because of interest rates. Interest rates are higher today than they were in 22, but because it was the expectation that interest rates were going to slow, and so that became the self-fulfilling prophecy. That part of the expectations channel, which is a very important channel for monetary policy, we've already seen that play through. To your point, it's when you get into the real economy impact, and usually they're not so separate. Usually they're closer together because companies have short-term interest rate exposure on their balance sheets, or consumers do. You go back to the pre-Great Financial Crisis in 2005, 35% of mortgages were floating rate. So when you raise rates, you see people get priced out of their existing homes. This creates foreclosures. This creates housing issues.
And that's why we're seeing this much more acutely in Canada, in the UK, because those countries have like 5-year mortgages, not 30-year mortgages.
And even then, I was actually just looking at some of the Canadian data. You've seen unemployment go up more there than you have in the US, but Canadian housing data is actually holding in. House prices are pretty resilient. It's pretty incredible given how short their mortgage cycle is. It speaks to that the Canadian economy has remained rather robust. It's a really good question as to how it's been able to remain so resilient, but I was surprised at that data. But I would say that the thing to watch and sort of the counter argument is that yes, the majority of consumer debt exposure is through mortgages. And if you look at the average effective rate of mortgages, it's still sitting, I think, below 4%. And that's much less than the new rate if you were to go out and get a new mortgage. But housing activity has held up, housing employment has held up. That's another very long lagging kind of indicator. But if I look at other kinds of exposure on consumer balance sheets to shorter term rates, you can see them starting to bite. Look at delinquencies for credit cards and autos. Autos, I know, are unique because of all the dynamics of people buying really expensive cars above MSRP during the pandemic, but they've both skyrocketed higher to levels that we typically only see during recessions. And that's peculiar because we have a tight labor market on the surface. Incomes haven't dipped at all. Real wage growth is still positive. And yet consumers are starting to feel the pain or kind of are buckling under the burden of higher debt levels. If you were to actually see income weakness, where would those delinquency rates go? I think is a very good question.
My guess is you would think substantially higher, even though they're elevated right now.
And you've probably heard the argument from people saying, well, we're not going to have another consumer balance sheet recession. That was 07. You're not going to have issues with the consumer balance sheet. And I'll agree with you. There's lots of stats. You can look at the growth of household assets versus liabilities. Prior to the great financial crisis, liabilities were growing much faster than assets for 3-4 years, effectively creating the scenario for balance sheet issues. However, I think there's nuance in this is that there are pockets of consumers that are going to have balance sheet issues because debt levels are high, because interest rates are high, and the end result is you're starting to see this perk up in the delinquency data.
All right, so you're taking this exactly where I was hoping to go with it. I do want to get to, there was a chart that you pulled up about tailwinds and headwinds to the markets. So I want to bring those up because I know we're kind of digging into things that could derail this situation, but there are also some things that could keep it going for a lot longer. So I want to make sure we don't ignore those. But yeah, so consumer spending. So I think if we look at retail sales, they're not barn burner sales going on right now. They're not terrible, but they're not barn burners. If you look at a lot of the consumer companies out there, you're seeing a lot of them begin to report weakness in the consumers, right? And we've all heard the headlines from Starbucks and Tyson Foods, and there have been several others there. Red Lobster just went bankrupt. Even Walmart. Pardon me?
Too much shrimp.
Too much shrimp. Their all-you-can-eat buffet was just a total loss leader for them.
I would like to think I had a hand in causing that bankruptcy by eating too much shrimp, but I tend to spend more of my time at the macaroni and cheese bar at a Cracker Barrel, or not a Cracker Barrel, at a Golden Corral. So
Golden Corral.
if we're doing buffets, I'm gonna go that direction.
All right, everybody, go long Golden Corral because Cameron's going to eat after we finish here. But the point is it does seem like we're starting to see the consumer really start to pull back a bit. We look at revolving debt. We've seen that just explode post-pandemic, and that's when it's charging record high interest rates. So it does seem that consumers are having to put more and more of kind of just the basics of their lifestyle on plastic, and we know that has a there's an endpoint to that. They can't do that forever, right? So we're seeing a lot of these sort of signs of stress, if you will, on the consumer side. The jobs market too. I mean, everybody points to the fact that unemployment's still relatively low and job market's still relatively tight. And I got to tell you, not only does everybody have a field day when the BLS data comes out and says, look, this stuff's really hard to believe, and they always revise it anyways, right? But when you look, looking at things like claims, like initial claims, they barely budged all year. But we've seen, an eruption in layoffs. We've seen a massive spike in more notices. There just seems to be a lot of increasing divergence between the narrative of how tight and rock solid this labor market is versus what real people are saying. And I've had a lot of conversations with this sort of through my social media channels and in real life with other people. And yes, this isn't a scientific study, but it's pretty overwhelming. What people say is like, it's really hard to get a job out there, that most of the job listings out there are kind of for optics. They're really not actively hiring for them. So the point is it just seems that there's a lot of data out there, some anecdotal, some official, that really does seem to show that the consumer is weakening. And at the end of the day, we're a 2/3 consumer-driven GDP. You said it's all about the GDP forecasts. So how concerned are you that the consumer may well indeed be starting to tap out here, which will then have economic repercussions down the road?
I think the most concerning chart, the one that we call it the chart that keeps us awake at night, is the relative performance of consumer discretionary versus consumer staples. I bring it up because this chart has tended to lead forecasts for household consumption, that 2/3 of GDP. And meaning that in a year like 2022, cyclical discretionary stocks were underperforming defensive staples stocks, and you were seeing household consumption forecasts fall. They bottomed in late 22 and into 23, the stocks did, and they led the bottoming in household consumption forecasts. Over the last 2 months, that discretionary versus staples, equal weights, you remove the outside impact of an Amazon or a Tesla, has rolled over and it's back to trend, and it's sitting at a very precarious level. If that changes trend, if we actually see a trend change in that, I think the argument that we should give the consumer the benefit of the doubt starts to flip to say we should be asking more questions, because the stocks will sniff it out. Consumer discretionary is one of the worst performing sectors in the S&P 500 this year. It's trading at new relative lows versus the market, at least as of Friday, maybe or Monday, maybe some trading has perked up a little bit. But it is disconcerting that the equities, which tend to be really good sniffers of potential trend changes, are flashing some yellow signs that say, hey, don't get complacent and just look at non-farm payrolls data or initial jobless claims to say everything is dandy. I think that Mike Green from Simplify has done a lot of really great work as to why claims have been so low, mostly in states like California, where you have seen more layoffs, but you haven't seen people file for claims. He argues that it's because people can make more doing things like Uber and DoorDash than they can filing for unemployment. And so,
Right. And sorry to interject, but he said that in California specifically, which is where I live, he said that they haven't updated their unemployment benefits in over 20 years.
yeah.
Right. So yeah, I get it. Like that's not, who's going to live on that?
Yeah, and so I think that can help explain that. If we go into the non-farm payrolls data from last month, what you saw was a really sharp slowdown, not an actual shutting of jobs, but a real big slowdown in a lot of the cyclical parts of the job market, so manufacturing, construction, leisure, and hospitality. So I'm very curious about the May data to see if that was a blip, or if that actual slowdown to where you were only adding a few thousand jobs in those areas actually falls, because we haven't technically been shutting jobs in the non-farm payrolls in a broad way, right? Of course, we're adding jobs each month. They've been over 200,000, but we're watching for those specific sectors to see if there's signs that you're starting to see jobs fall and labor demand actually fall, because that's been the other key interesting thing. 23's increase in unemployment was because labor supply went up so much, not necessarily because labor demand fell. So that's when, if labor demand starts to soften, when you would start to be more concerned about the consumer. Because look, at the end of the day, the consumer, this is not, I say this and people go like, well, great, great insight. This is real smart to say. Consumers when they have money, they spend money. But it's true. When they have jobs, they spend money. And as long as the job market stays tight, then it behooves you to remain optimistic about consumer spending. They're like Finding Dory, we say. It's like, just keep spending, just keep spending.
Okay, so here's where we get maybe to the crux of the consumer story. I talk about this a lot, which is the difference between the mean and the median.
Mhm.
Um,
Yeah.
it's same thing with companies too, but like, you know, the wealthy end of the consumer curve, they're doing great,
Mhm.
right? They're well employed, their jobs are paying them a lot, but more importantly, they own a ton of assets and the assets are doing great, right? When you look at the median, it does seem that the median is falling behind and falling further behind as time goes on. You said as long as people feel good, they keep spending. I saw a recent survey where it's basically like 2/3 of respondents said that yes, wages have started picking up, but they have not increased enough to make up for the increase in cost of living, right?
Yeah.
So obviously the wealthy cohort, they're responsible for an outsized amount of the consumer spending, but they don't do it all, right? So I'm curious on this. I mean, how much in what you look at do you kind of look at the median versus the mean? Is the median even important, or does it just matter what those with money are doing?
No, I think it's incredibly important because we all do breathe the same economic air. And we saw weakness in the lower income consumer in a year like 2022 when real wage growth was negative. And so you saw, if you looked and went to stocks, you could pull up and see the chart of a stock like Rent-A-Center, for example, did really, really poorly in 2022. They typically serve the lower income consumer, rent to own durable goods, effectively furniture and appliances and electronics. So you saw that low income consumer, and you saw the end result of how that filtered in through the economy. GDP growth slowed, but even the best, greatest companies at the top, think of like a Google and a Meta, still struggled because advertising revenue fell.
Right.
Like somebody like Meta's 98% advertising revenue. And in a strong economic environment, hot dog, that's awesome, right? Because they benefit from upside growth. So the point is to say you can't ignore the median because for growth expectations to continue to be ratcheted higher, you can't have certain pockets of the economy not participating in the consumption. So I think it is a very important thing to watch. Now, the one thing I would caution to say is that consumer sentiment can be very misleading about actual spending behavior because consumer sentiment has been weak since really since 22 when consumers started to lose purchasing power, when real wage growth went negative, but they kept spending. Overall, they kept spending.
Right.
And that
And
is a
sorry to interject, but just so you can address this in your answer, sure, a huge part of that was what I refer to as the pig and the python, where they had a lot of flush, or I don't know if they're flush, but they had excess savings from the pandemic, which recent charts I've seen now actually show that they believe that that is now totally done.
Yeah, and that's you see, and that's such an important point, which is that if you go back to a year like 22, it wasn't just incomes that were fueling spending growth. You had the benefit of spending down to savings, and you had the fact that overall debt levels as a percentage of income had plunged in 2020 and 21.
Right.
So
And
there was
you had moratoria too on your student loans, on your rent, on your, you know, your mortgage.
and delinquency rates had fallen materially, and actually absolute debt levels, so not just relative to incomes, but absolute debt levels had fallen. So the end result was that you had a huge amount of runway to take on more debt, spend down savings. Yes, you weren't getting checks anymore as of early 2022. Some people weren't, some people were, but there were still supplemental things happening with student income. So you were able to continue to spend, even though you felt terrible because you were losing purchasing power, you were still able to spend. It is such a good question if that can happen this time around. If we see wage growth, real wage growth turn negative, but you don't have runway from savings and stimulus and credit card or debt spending, will you be able to see consumers continue to spend through that? It's a good question. We'll see. I mean, I think that's what will play out. Oh, that we'll get the answer to that over the next 6 months.
All right. Well, let me ask my last question on this, then we'll get to your tailwinds and headwinds. So let's move to companies now, right? You have a similar issue with mean and median, right? Where we've got a few companies that are just crushing it, right? And they're like when you look at the profitability, the profits, right, of the S&P 500, like the vast majority of those are made up by like the top 10 companies, right? There are a lot of companies in the remaining, S&P 490, we'll say, that aren't doing so great from a profitability standpoint. And so, and then of course, when you go lower than that into just the medium and small business side of things, a lot of those companies are really struggling. And this whole, debt re-rating thing we're talking about, those companies have a much harder time, right? They don't have the big cash balances. They don't get as good deals on the debt terms and all that stuff. So the reason why I bring that up is because it's those smaller companies that's where the majority of jobs are in America, right? And so, how big of a concern is that as we go further along here, where the lag effect may beginning to really start arriving, we get those bottom half, bottom 2/3 companies having to tighten their belts, and we start seeing actual real layoffs, and then that's an additional injury to the consumer side of things, and then you begin to kind of get the vicious cycle that you do when you fall into recession.
Yeah, I mean, for the last 18 months, we've been thinking of, what does this recession look like? If it's not a large corporate balance sheet recession like you had in the 2000s, that was a corporate balance sheet recession, all of the Enron and WorldCom and Sarbanes-Oxley after that caused a big, huge kind of commotion within short-term borrowing. In result, you had a big rationalization of corporate balance sheets that had to happen. 2008, you had, of course, the consumer balance sheets, you had bank balance sheets that had to be rationalized, but that was the nature of that balance sheet recession. So we've been thinking, okay, what would this balance sheet recession look like? And we thought, maybe it's small business. Maybe that's the area where, because they have more exposure to floating rate debt, to shorter term funding, maybe because they've taken on a lot more debt, more companies have stayed private and not IPO'd and gone public like you've had in prior cycles. Maybe that's where you start to see pain. And I think the thing that surprised us is how resilient they've been, even despite these higher interest rates. A lot of these companies rely on very short-term floating rate debt for funding. A lot of the things that have moved out of the banking channel and into the private credit channel. And so we talk to a lot of the private credit guys and we say, hey, what's going on? How have they been able to deal with much higher interest rates? And they go, it's okay because incomes are up so much. And this is that funny thing about inflation, right? So their income growth, which is nominal, has benefited from pricing power and the strong economy and inflation, which has then allowed them to be able to tolerate these higher interest rates. But you have a denominator issue, which is that your denominator, your income, if that starts to wobble for any reason, all of a sudden that numerator, your debt levels, starts to look a lot less tolerable. And so we're constantly talking with private credit guys to say, what are you seeing within your books of business? Are you starting to see more credit events picking up? We've been surprised that you haven't seen more of it yet, but that's not to say it won't happen. If a company really does have too much debt, I'll make one last point on this. If the company has too much debt, I don't think 25 to 75 basis points of Fed cuts at the short end of the curve will necessarily bail them out. However, it could allow companies to breathe that sigh of relief, banks to breathe a sigh of relief. And that's where you get back to the expectations channel, that if you think that the Fed has your back, are you more willing to underwrite again and further for loans? So I do think that small businesses should be watched closely. Small cap, the issues on the balance sheets are very well known. We've written about them a ton. With small caps in specific, one of the things we've been talking about is to say they went from being very, very consensus bullish at the start of the year. People were saying, you got to buy small caps because the Fed's going to cut interest rates and it's going to be awesome because incomes are strong and the balance sheets will get bailed out. And we stayed underweight small caps. Now we're looking at small caps going, well, everybody's saying you can't buy them anymore because of the balance sheets. What could we actually, what could we find? And so what we're looking at is we're actually just launching a mid cap strategy because we're saying, look, there's a lot of companies that are really undervalued. If they have good balance sheets, if they generate free cash flow, good return on invested capital, there's room to play there. But overall, to your point, 40% of the Russell 2000 is unprofitable. So, and that's in a strong economic environment. So what
And that's
happens
the whole
during a
point.
recession?
Yeah, exactly. We're seeing these stresses in the consumer space, and that's with everything kind of Goldilocks, right?
Yeah.
But anyways, it is so great answer. I'm just going to ask this last question because you mentioned it in your answer there. Private lending has really become kind of a big thing this time around. I'm curious, what are your thoughts on it? And I guess let me ask a concern that I've heard voiced, which is it's a lot more opaque than the banking system. We don't necessarily know how well capitalized these companies are, what their lending standards are. And some might say, hey, don't worry, this is the free market. These are smart companies. They're going to make good loans because it's in their interests. And others are saying, oh, wait a minute, is this just like a whole subprime, crisis ready to happen at some point? We find out how terrible these loans were made and they just start defaulting everywhere. Do you have any insight one way or the other into this?
I thought Jamie Dimon was really interesting a couple of weeks ago. He was asked this question about regulation, and he said, who would you rather do this lending, us or some guy who's never done it before? And I would think that the regulators would say we'd rather JP Morgan do it. But in some of the regulations coming out of SVB, the actual impact has been to push more of this outside of the banking channel. The funny thing is that the banks are now wanting to get the business back, so they're bidding on some of these private credit deals and causing spreads to compress, which is a funny and kind of different scenario. The phrase "a golden age for private credit" is thrown out a lot, and a colleague of mine says it's not a golden age for all; it's only a golden age for some. And I add on to it, I say it's a golden age for asset gatherers, which just means that it sounds appealing because you're getting, high base rate and you get a big spread and people go, oh, I can earn 10, 11%. This is fantastic. Not realizing that, of course, if the Fed were to cut interest rates, that your base rate falls. And if you were to have credit issues, then your NAVs could fall, et cetera. But I do think that working with the right underwriters, then, it still deserves a place in a broader asset allocation, meaning that, we can show how it can play a part in broader asset allocations. However, there's been so much new capital that it's entered the space that we think that there are a lot of people who have no business being in the private credit, private lending space, which just means that the due diligence requirement of anybody getting exposure is incredibly heavy because you have to be able to work with the right underwriters who have workout teams, who've underwritten through down cycles and aren't just new to this. Because to your last point, some of the deals are great, but how many of the deals are done just because they have to allocate the capital that has been given to them? That's the question you have to ask yourself.
Yeah, absolutely. And yeah, I'm sure there are probably some great deals in there, but it does beg the question though, well, how great can the deals be if banks wouldn't do them?
Well, and it part of it is that the banks may want to do them, but they just can't do them. And part of it is also the structuring that can be very specific to what the company needs versus going through like the broadly syndicated loan market, which makes it much more standardized and across the board and working with this specific investor. I get that. And to your point, let's just reduce the asset class to what it is. It's floating rate debt to companies that banks won't lend to.
Right.
So if you can control for that risk and you're a good underwriter, then that might actually be a fantastic place to be. If you can't, or you've not done it before, then that's where the issues could be bigger.
Right. And what I worry about in that environment is sort of what happens in venture capital, right? Which is the really good firms, they get all the good deals, right? And then every other firm is competing over the deals that the big firms passed on. And if they passed on it, they probably passed on it for a reason. And so you're just putting an increasing amount of lipstick, on those products as they get passed around.
We say that, sometimes we'll see deals come through, and I call it the Groucho Marx problem, which is that I'd never want to be part of a club that would have me as a member.
Mhm.
And we always ask the question, why me? Why now?
Got it. Yeah. If someone's offering you such a great deal, you got to wonder, why? All right. Well, look, I did promise I would get back to your the main thrust of your recent piece here. It's going to take me a moment to find it here. But we're sort of in the point here now where I'd love to ask you about your general market outlook. So I'm having trouble actually pulling up the table of your headwinds and tailwinds. So maybe you can just sort of incorporate them into your answers there. But what do you think the market's likely to do for the rest of the year as we get closer and closer to the uncertainty of the presidential election? And maybe which tailwinds are you most excited about and which headwinds are you most nervous about?
Yeah, I think let's start with the tailwinds, which we kind of started the conversation in talking about some of the technicals, but they're important to identify, which is that the market's in an uptrend. It has momentum. You can look at it from daily, weekly, monthly momentum on things like MACD are still positive. Breadth has improved. So you've seen a growing number of names participating in the rally, not necessarily equating to better equal weight outperformance. That's kind of an interesting kind of catch here, which is that the equal weight index is actually making new relative lows versus the cap weighted index. So this is still very much a top heavy market, but more stocks are participating in and are in uptrends. And we also have
sorry to interject here. I did find the table, so I'm going to put it up here so folks can look at it while you're continuing your answer, Cameron. Sorry about that.
Perfect. And so we also have seasonality, which is a tailwind in the short term. So you put the technicals together and you have folks like Jeff DeGraff at Renmac and Chris Verone at Strategas, and they're saying, hey, 5,600, 5,800 is in play. If you look at the breadth thrust that we had in October of 2023, and that can then lead to much more upside. And Jeff DeGraff saying, don't fight it. The seasonality is strong, momentum strong, and the trend is still up. So that would be, you'd put that into the camp of tailwind. You put liquidity that we started the conversation into the camp of tailwind with Fed tapering, some of the dynamics around Treasury liquidity, spending down of the TGA, for example, just means that liquidity is not flipping to be a headwind like it was in 2022. Share repurchases just hit their highest level since 2018. So that is something that is supportive as as an input into stocks, as an inflow into the market at the same time as helping with EPS, which leads you then to GDP and EPS forecasts, which have been flat to up. And as long as they're flat to up, we think that you get a bid for risk assets that can then allow, if inflation falls, yields falling for a good reason, which is that, hey, the Fed's going to cut because inflation's falling, not the Fed has to cut because growth is falling. So
Right.
that's where that's the summary of tailwinds through the end of the year, which are all well and good. And then we have to look then to the headwinds. And this is where you'd say that there's some kind of cracks and what we're watching for, but the timing of these is very uncertain. We talked about defensives outperforming, things like staples outperforming discretionary, or we show it as discretionary underperforming staples.
Right. That's
We
the
know
chart that
value.
keeps you up at night, right?
It's the chart that keeps me up at night, is going, oh, what's the market trying to tell us? Utilities have been outperforming, but could that be more of a function of AI hype and optimism? Yeah. It's kind of it's a good topic for debate. But the fact that discretionary again is at a new relative low, a year-to-date low versus the market, it's telling you something, and something we shouldn't ignore probably. Valuations, whether we're looking at equity or credit, are getting close to complacent territory. They're effectively not pricing in any potential for anything bad ever to happen. And that's where you say, okay, it's flipping to one side of the boat. Positioning is looking more and more extended. It's not at the point where it's extreme like it was in times like 2018 or 2022, but you're certainly getting to a point where when you put valuations, positioning, sentiment all together, they're definitely at the very high end of the range. That's not a catalyst on their own. It's such an important point. what those do instead is that when they are extreme, they A, make you more sensitive to incoming catalysts, or B, they create an outsized reaction in the opposite direction. So what I mean by that is that at the low of a market, if valuations are low, positioning low, sentiment is low, you can tolerate a lot of bad news because everybody's already sold. But at the top of a market, when valuations are high, positioning is high, sentiment is extended, you can't tolerate nearly as much bad news because you're already put all your hopes and dreams into good things happening.
Great point.
So these are things that aren't catalysts, but they act as potential headwinds if you see something cause an unwind. Then we talk about sticky inflation and max cuts priced in. I think this is an open topic for debate. We think that the Fed hasn't really mattered for markets because growth has been so strong. And the end result then is that the market has been able to shake off higher rates, tighter Fed, simply because you've seen the growth rates continue to get revised higher, which just means that that last point, GDP and EPS growth forecasts are probably the most important thing that we're watching. If you start to see GDP estimates get cut or EPS estimates get cut, that's when the regime shifts. That's when the risk regime starts to become a lot less optimistic about the world. That's your catalyst for some more market volatility. The challenge is we're not seeing enough evidence yet that we're making a call that you need to cut estimates, that we're going into recession, that's something that we're not seeing that evidence yet, but we have to watch all those things like the consumer, like PMIs, for example. All these points come together to say, we think we're at a peak in revisions higher, but we're not quite at a point yet where we're going to be cutting estimates lower.
Got it. And I'm pulling this up from your recent report, but if you look at 12-month forward PE estimates for the S&P, I mean, it's kind of at an all-time high right now, right? I mean, you're not seeing much signs for concern there yet, correct?
Yeah, and that's to your point on lags, this is a really lagging measure because for a few reasons. It just benefits from time. So the equity market is an optimistic machine, which means that it typically has growth forecasts into the future. And the reason why this is lifting so much as we go through the year is not because analysts are actually revising their forecasts higher. That's not happening. They've been flat. What's happening instead is that you're including more of the 25 forecast into this 12-month forward number. So, in January, you start rolling forward and you start bringing in a month of growth from 25 each and every month as you go through the year. And of course, in 25, you have estimates that are for really robust growth, 12% earnings growth driven by huge multiple expansion, big revenue upside. There's a lot of optimism baked into those 25 numbers. So what happens is that eventually, if you start cutting 25 estimates, that will start to taper off and potentially roll over like it did in 22, because you were cutting 22 and 23 estimates back in 22. But note, this didn't peak until about 5 months after the market peaked, and it bottomed after the market bottomed. So it is a lagging indicator.
Okay, so just getting to the GDP growth forecasts, you'd mentioned that they were flat to up, maybe even up pretty robustly. So sounds like no warning bells on that front yet either, correct?
If there is one, it's the City Economic Surprise Index. It's now flipped negative in a meaningful way for the first time since 22, which of course was the last time that we were cutting forecasts for GDP. So that City Economic Surprises has been falling because of weaker retail sales, because of the weaker payrolls print, because of weaker PMIs. And the question is, if it persists, can we really keep raising GDP forecasts for 24? Or are we actually going to be in a point where data is just coming in much weaker than expected and we have to cut forecasts? If you look at what the street has expected, what we're thinking about is, okay, what would happen if GDP forecasts, what could cause them to go further higher? Okay, well, the back half of the year, there is a deceleration already priced into forecasts, so maybe that can move higher. It already has. There was a huge deceleration priced in a couple months ago, and that's been effectively priced out, which has raised the full year estimate. You also have that 25 has a pretty big deceleration baked into it already from 2.4 to 1.7% next year. So maybe there's upside there. To the downside, it is that weaker city economic surprises, data coming in worse than expected. And if that continues, that could suggest that some of these estimates or forecasts could be revised lower if it continues. That's why watch the incoming data like retail sales, PMIs, non-farm payrolls. All of this will feed into that city economic surprises and thus the GDP forecast going forward.
Okay, great. All right. Well, look, Cameron, I love interviewing capital managers like yourself because you don't have the luxury of just having an opinion and waiting to see whether it's proved right or not. You actually have to manage client capital in all this, and you have to be held accountable for the performance. So how are you allocating capital right now in this type of environment with your outlook here? What are some of the asset classes that you're favoring? Are there any particular strategies that you are leaning into or leaning away from right now?
Yeah, so when we think about our asset allocation spectrum, we cover the gambit from your traditional assets all the way to the non-traditional alternative assets. Within traditionals, I'll run through kind of some of our exposure. We have a quality overlay to all of our equities and our credit that we're doing right now. We think that quality is important, mostly in this later cycle kind of environment where there's economic uncertainty and where balance sheets really do matter. So everything we do across the equity spectrum has that quality focus. It doesn't mean that we're deep value. It doesn't mean that we don't buy growth names, but we have some pretty strict things in how we define quality. We are overweight large cap versus small cap. We're constantly debating if that needs to change. We've been very happy with that weighting and that exposure. Have been that way for quite some time, for 2 years now, at least. Within international, we are neutral international overall, but we're overweight developed versus emerging. That's another point of debate, given the big move and breakout we've seen in Chinese stocks. They have been a falling knife and a value trap for much of the past, let's call it 6 years. You've had these little bursts of outperformance that have dwindled, and actually you could roll back even further to the peak in 2007 that the overall EM index has been a value trap. But we're constantly looking at that to see if it justifies changing our weighting. Within fixed income, we've been underweight duration this year, but are moving a little bit. We've been kind of taking advantage of bond sell-offs in order to extend duration. We're neutral on credit. We're still, because we're not making a big call for being underweight, riskier kinds of things, and because we're not making a call that we need to be cutting forecasts yet for GDP or EPS, that still justifies having exposure to things like high yield and investment grade. If we think we're going into a recession, that high yield exposure will likely change. But as of right now, we're not making that call. Within alternatives, we think that there are opportunities across the alternative spectrum, but you have to do incredible amounts of due diligence to pick your spots carefully. For example, within venture, we do a lot of stepping into the fray. So we stepped into the fray last year in venture, working with some fantastic managers, best-in-class managers, to get exposure to venture when everybody else was a whooshing sound leaving the door. It's something similar in private equity this year, where everybody said you can't allocate to private equity, interest rates are staying higher for longer. But we focused on those with great operational excellence and added value, not just through financial engineering. We do a lot we've been very selective within private real estate. There is a lot of disruption in those markets where we think that putting new capital in the ground, so new fund structures, investing at today's valuations, given today's interest rates, can be attractive within real estate. We haven't seen the distress levels enough be acute and broad enough to justify, you know, stepping in and doing a bunch of really big distressed real estate types of activity. But we've been sharpening our pencils, what feels like for a while. Private credit, another example of high degree of selectivity. Real assets, lastly, we do think that investors are under allocated to infrastructure. It's been boring. It hasn't been as exciting as big moves in equity markets, but we think the countercyclicality and the lack of correlation to other asset classes can be very compelling. So you would, and you know, then commodities have a place as well within that real assets as a diversifier. So you put it all together, you know, really diversified portfolios, looking for opportunities where there is disruption, but also keeping a steady hand with that quality exposure is kind of our big key themes.
All right, that is fantastic. Thank you so much for being so generous with being so specific about how you are allocating right now. Well, look, Cameron, we're a little past the hour. Thank you so much for giving us so much time. I'm going to start to wrap things up here. The next question I have, though, is very, very important, which is for folks that have really enjoyed this conversation, maybe it's their first time getting exposure to you. Where can they go to follow you and your work?
Yeah, definitely. So I am on X, Twitter, at Cameron Dawson, and same on LinkedIn. You can find me, Cameron Dawson. I think CFA is the name to search. You'll see
All
me.
right, fantastic. And I will put up an overlay with your handle on it when I edit this video.
And you can also go to the NewEdge Wealth website and sign up for the pieces as well. I forget that.
I was just going to ask you for that one. Okay, great. I'll put up the URL for NewEdge as well here. And folks, the links will also be in the description below this video if you just want to go there with one click. All right, I've got one last question for you, which I'll give you about 30 seconds to think about while I do some other housekeeping. And that is, what is a big lesson that you've learned along the course of your successful career so far that you think is worthwhile imparting with the audience here? So quick housekeeping, folks. If you've enjoyed this conversation, this excellent conversation with Cameron, and would like to thank her for both her generosity, but also encourage her to come back on the program again in the future when she has an update on her outlook, please let her know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And really, please, if you can, subscribe, folks, because we're trying to get to that 100,000 milestone. We can get there faster with your help. Also, in this type of, this crazy market where things, have a lot of tailwinds against them right now, but there's a lot of potential headwinds out there that could change up the mix. Hard for a lot of folks to navigate this on their own, especially if you're just a regular person with a job and a family to pay attention to. So that's why I highly remind people to recommend that people work with a good financial advisor who understands all these macro issues that Cameron and I have talked about. And when you take those two requirements together, they've got to be good and they have to understand these macro issues. The universe of financial advisors that fits that overlap is actually quite small. But if you've got a good one who is being your good financial quarterback, great, stick with them. They are worth their weight in gold. If you don't have one, though, consider, or would like a second opinion from what it does, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds to do that. Also, while you're there at thoughtfulmoney.com, that's where you can sign up for our free newsletter as well. All right, Cameron, we're back to you now. What's a big lesson you've learned across the course of your career so far that you think is worth sharing with this audience of regular investors?
I think it's a helpful activity, which is to, if you're working for somebody, is to write down your accomplishments. It's really important that you don't lose track of the things that you've done and been able to achieve, because you have to advocate for yourself. And I think that's one of the best pieces of advice that I got in my career early on from a great mentor who said, don't lose tracks of the things that you've done, because you're going to have evidence for whatever you're arguing for at some point in the future. And it's such a helpful activity that allows you to slow time down a little bit, see the forest instead of just the trees. and really take a step back and not only, you know, have the piece of being grateful to yourself for all the things that you've done, but also arming yourself with all the details and the data in order to be able to really advocate for yourself, which I think is so very important. So write them down. I keep a detailed journal all the time, and this is as much me giving myself the advice, because it's due time that I spend some time saying, this is what we've done. It's good. So I think it's a helpful activity, and one that people should do more of.
You know, I'm so glad you mentioned that. I completely agree. As a guy who worked in corporate America until he turned 40, you know, I learned that this was really kind of crucial if you really want to advance, right? Is to be able to, you know, enumerate, hey, this is all the value that I created. And it's amazing, you know, once you start doing that, you oftentimes surprise yourself with like, wow, I'm actually getting a lot more stuff accomplished than I thought. But I think a really important part of it too is it lets you reflect once you've written it down here, in terms of deciding how to evolve your career in the future, because you can look down at what you're doing and saying, okay, this is what I've done. Is this the type of career that I want to be having? Is this the type of professional track record, the difference in the world that I want to be making? What's not on this list that I would like to have on that list next year or in 5 years or in 10 years, right? So I find that there's an old saying in business, I'm sure you know it, Cameron, if it doesn't get measured, it doesn't get moved. And this is a really important way of measuring your career progress and then challenging yourself to say, okay, is this moving in the direction I want it to? And if not, what do I need to do to get it to where I want it to be? So great point.
If it's a trading diary, make sure you write down your failures too. That's important on both sides.
Yeah, and again, great point, which is this is how we learn, right? If we don't record, you know, what we've observed, we tend to forget, right? And if we want to get smarter and make fewer mistakes in the future, it's essential to do that. So, all right, Cameron, fantastic answer. All right, look, this has just been so wonderful. Thank you so much for coming on. And as I said, open door here to come back on the program anytime you feel that your outlook has evolved enough that you're seeing something a little bit different. You want to let our viewers know about it.
Will do. Thank you so much.
Such a pleasure. Thank you, everybody else. Thanks so much for watching.